And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. Of course, it is Thursday. Getting ready to wrap up this week. You know, it's been interesting, right? It's been an interesting first kind of full week of the year. Had Jay Powell, we've had all this other stuff going on. Markets continuing to do well. You know, Google puts out an advertisement yesterday for their new AI intelligence. It's supposed to answer all your questions for you. It was wrong, but sent the stock down 8% yesterday. I think that was a little bit overdone, by the way. I mean, yeah, you know, look, this is all very much in beta testing mode right now. And if there's anybody that's going to work out the glitches in artificial intelligence, it'll be Google, considering how much intelligence they have on you anyway, right? So, you know, pretty much, I'm not even sure the answer was wrong. Based on all the misinformation that's out there, it's probably just giving you the answer you thought you wanted. So don't worry about the truth. Here's what you get. Anyway, stock sold off yesterday. That was kind of one of the big drags on the overall market because of its market cap weighting. Market was down a bit. And again, not surprising here, and we've talked about this over the last couple of days, is that markets have had a very, very significant run. And for instance, the CNN fear greed gauge, which measures stocks, volatility, those type of things in the market, is now back to extreme greed levels for the first time since January of 2022. So, you know, we've gone a very long way. And again, you know, we talk a lot about this rally since the beginning of the year. It's like markets are up this much since January. This rally started long before January. In fact, it goes all the way back to October of last year, where we started that rally right at the end of October, started this rally back then. So this has been a very extended bullish trend rally here for the last several months. And again, we've had a lot of positive developments. The 50 days now crossed solidly above the 200-day moving average. The 20-day is above the 50 and the 200-day. So you've got all these kind of moving averages now providing additional support underneath the markets, which make downside risk a little bit less, right? Because now you have these support levels. So what we'll be talking about today, Michael Leibowitz joining me this morning, is we'll be talking about this problem that we have in the markets right now, which is this technically bullish trend of the markets, but the fundamentals remain terrible. And, you know, there's still all these concerns about economic recession, inverted yield curves. We have all of these fundamental variables out there that are certainly bearish in nature. But despite that, you have this rising bullish trend of the markets. Now, let me just say this. First of all, markets are very overbought here. And, you know, we watch very closely our buy and sell signals. And our buy signal that we got back in early December has now made the vast majority of its move and actually is becoming very close. If we get a couple more down days in the markets here over the next week or so, that sell signal is going to trigger, and that's going to suggest that we're going to get a pullback in the markets to around 4,000-ish. That would be the first kind of major support point for the market. So again, markets are going to go up and down even in a bullish trend or in a bearish trend. And we saw this last year, right? Markets were in a bearish trend. Prices were declining overall, but you had some fantastic rallies last year that, you know, you could make a lot of money on. I mean, markets rallied 7, 8, 9, 10, 11% at times, but we're remaining in a bearish trend. And so again, you know, markets don't just go straight up or straight down. They kind of bounce along the way. So there's opportunities to make some money when these bounces occur. The question, though, and this is what we'll explore today with Michael, is to look at what the Fed said, of course, at the most recent speech by Jerome Powell, who made no qualms that they're going to keep hiking interest rates. And if you take a look at what's happening with the employment report, that jobs report in January provided a very strong basis to keep hiking rates. And inflation is still potentially a problem because, again, you know, while inflation is coming down, the big concern for the Fed is that they stop too soon on tightening policy and you get a resurgence of inflation. And that's what they want to try to avoid. So again, we have these competing narratives for the markets, which make it extremely difficult to invest, right? I mean, it's like you're on one side of the camp, and you're like, oh, this market's going to go down. We're in a big bear market. We got to go down to 30%. So you're all in cash. And then the market rallies, 15% on the NASDAQ in a month. So, this is the narrative. The other side of being extremely bullish here is like, hey, the bear market's over. We're back into a bull market. That's not necessarily the case, because we do have to pay attention to what's happening with the fundamentals. So that's going to be the conversation this morning. We're going to get into a little bit more of that, really talk about how to position as we go forward. A couple of quick notes, though. First of all, a very interesting chart out this morning. I just posted it on Twitter. So if you go to our Twitter account, @LanceRoberts, you'll see this post. But my friend Albert Edwards, who is an analyst for Societe Generale, posted out a very interesting chart. Actually came from another friend of mine, David Rosenberg, who talks about the jobs that were created. So we had this 500,000 job increase in January, right? Pretty phenomenal, right? It's like, man, just created 500,000 jobs. Actually, every January, and we've talked about this before, there are massive seasonal adjustments. We lose about 3 million jobs every January. This is because of seasonal hiring getting rolled off, right? Think of all the people that get temporary jobs at Macy's and Nordstrom's, et cetera, for the Christmas holidays, earn a little bit of extra money, but also to help out with the Christmas rush and all these type of things. So we have all these temporary jobs that are created in November, December for the holidays. Well, those all get terminated after the beginning of the year, right? Holidays are over. So you always have these big declines in jobs in January. So to smooth this data out, so we don't have these big jumps in the data, and the Bureau of Labor Statistics apply these mathematical formulas to smooth out these seasonal variabilities of hiring that occur during periods. Like, for instance, summer. We have a lot more temporary jobs in the summer, so we have to smooth those out because college kids are home, working gigs, whatever. So the mathematics behind all this is very interesting. But the interesting part about this is that, yes, while we continue to create payrolls, right, we continue to have this payroll growth that's happening. Since last May, and this was the point that David Rosenberg made, since last May, on net, we have not created any full-time jobs. Since last May, so think about that for a moment. All of the jobs since last May on net have been temporary jobs. So just kind of a fascinating look when you start to look at the gap between what the payroll numbers are and what we're creating in terms of full-time jobs. There's a very big gap emerging. Now, why is that important? Well, the reason is that if I'm going to support a family, right? So it's me, my wife, couple of kids, in my case, 900. You've got to have a full-time job to pay those bills. You can't be working part-time. Well, you can, but it's tough to work 2, 3, 4 part-time jobs and make enough money to support a family. So it's full-time work that actually creates stronger economic growth. The full-time work allows somebody to buy a house, somebody to buy a car, these type of things. So full-time employment is very important. So if we're not creating any more full-time employment since last May on net, then what does that say for economic growth over the course of the next year or so? And there's exactly the point of our conversation this morning. Very bullish technicals here. Moving averages turning up, markets moving through very different types of resistance structures, etc. But yet we have this bearish economic data. So we'll talk about what that means for your portfolio, how to navigate that. Be sure to get by the website, realinvestmentadvice.com. Michael Leibowitz' latest article is out on the website. Our daily market commentary out already this morning. So if you go to the website, you can get our latest daily market commentary, but also subscribe. We email that to you every morning at 7:30, get you ready for the trading day. Also, our YouTube, and make sure and subscribe to our new Before the Bell channel. That's our 3 minutes that we do on markets and money, and get you ready for the trading day for the markets as well, video-wise. So it's all there for you. It's on the website, realinvestmentadvice.com. Subscribe to our newsletter, everything else for you. We'll keep you up to date, keep you informed, and help it all out. And best of all, it's all free. So stick around. More of the Real Investment Show coming up with Michael Leibowitz. We're going to talk about bull, bear. What does that mean for your money? Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So a couple of things here, just as we kind of get kicking off this morning, this Thursday. So futures are pointing up right now a little bit. Good bit of earnings out. We're getting ready to wrap up earnings season, so rapidly kind of coming to a close. On aggregate, earnings have missed across the board. Now, on average, that they've pretty much come in line with expectations, but once you really start to dig down a lot of these numbers, they were actually a good bit weaker than what estimates really were, at the beginning of the quarter. But if we go back to last year, now remember, these estimates are put out up to a year in advance. So if you go back to last March, we had estimates for the end of 2023 last March. And so if you go back to that point, there's been about a 20% decline in earnings since then. So now, even though companies are coming out and beating these earnings, it's because we've lowered the bar enough for them to get over it. But if you actually take a look at what estimates were expected to be versus what they turned out to be, is actually a pretty huge miss. So just, this is always the problem with earnings and estimates because, we're told, Apple's going to make this much or Google's going to make this much. And so if you buy the stock at the beginning of the quarter based on some earnings number, by the time you get to the end of the quarter, you wind up overpaying for the stock because earnings come down, and that's the problem with forward estimates versus paying for what we used to back in the day. Michael will remember this. But back in the day, we didn't have forward earnings estimates. These operating forward earnings estimates were something that were at the back of the 10Q report, which is this report that companies put out every quarter. And they would have their balance sheet, GAAP earnings, then that was pretty much was reported. And at the very back, on kind of a supplemental index, was their pro forma projected numbers. And nobody really paid much attention to that because it was all just guesswork. Well, beginning in about 2000, Wall Street said, hey, let's use that data because it makes things look a lot better. And so we started really using a lot of these forward operating earnings estimates, which are basically earnings that have none of the bad stuff in them. So again, if you're really looking to be a good investor long-term, use the trailing earnings, not the forward earnings. You'll end up doing better. But this morning, we've got AbbVie. One of our holdings is reporting this morning. Brookfield Asset Management, Canopy Growth, that's the marijuana producer. That's been kind of interesting. That whole industry kind of went up in smoke. Expedia, Hilton, Kellogg's, News Corp, PayPal, Pepsi, Philip Morris. Ralph Lauren, S&P Global, Thomson Reuters, VeriSign, Yelp, all are reporting today. Again, we're right in the midst of, we're wrapping this up, but we're probably about 85% through the S&P now. So most of this is going to start to slow down over the next week or two. We'll have a kind of a slowdown in this earnings barrage, but this earnings push has been one thing really kind of pop in this market all over the place as well. So companies are reporting earnings and they have a big pop or decline depending on what they did with earnings. So hopefully some of this volatility will slow down here. But part of this,
Lance, can I just add to that?
Yeah,
for a
yeah,
second?
go ahead.
Yeah, there's also another part of earnings that we can't capture, that we can't quantify. So we always talk about, how did the company do? Did their earnings beat estimates? Were their earnings better than last year? What about sales? How did they do? What about margins? But at the end of the day, what we're finding is that forward guidance. So when the CEO and the executive branch talk about what they expect for the year ahead, which they usually do after they release earnings, that tends to be just as big a driver of the stock price than the actual earnings. And that's just something we can't quantify, because it's just all descriptions and some loose estimates. And so you can have a company that had great earnings and great sales growth, but they're worried about something in the future, and the stock can go down 5 or 10%. Mm-hmm. Conversely, a company with really bad earnings, but a great outlook, which could push it up despite what looks like bad earnings. Because again, earnings are for the past, right? That's what happened last quarter. What investors should only care about is what's going to happen next quarter and the quarter after that.
That's right. Well, and again, this is kind of the interesting thing with Google yesterday with their bar. The only question I have is this morning there should be a company-wide meeting. Goes, okay, if you don't, let me back up real quick. If you don't know what happened yesterday, Google was down almost 8% yesterday because they ran this advertisement for their new AI. So this is their competitor to ChatGPT, which has been making all the media headlines lately. Of this AI, you ask it a question, it'll answer for you, right? It'll write you articles, it'll write essays for school, it'll write code for trading, etc. It'll do anything you want. Well, Microsoft invested $10 billion, so basically Microsoft owns ChatGPT. The competitor to that is Google's, their AI is called Bard. And so they ran this advertisement yesterday of a kid asking it a question about, a telescope who was the first to see very deep into space, and it answered incorrectly. And of course, this has just made massive media headlines. So two questions come out of this. First of all is can you fix the problem? And the second is who didn't fact check the answer before you made the advertisement? That's the only, seems like somebody would have said, okay, before we put this ad out there, let's just double fact check this thing to make sure it answered correctly. Apparently somebody missed that ticket. So somebody's out of a job today. Jobless claims will go up by 1 on Friday. Anyway, but look, if there's going to be a winner out of this, it's going to either be Microsoft or Google. I would bet on both horses. The Google will fix this problem, and like I said earlier, as much live information as Google has on every single American, they're going to figure out the AI situation. Don't worry about it. But this brings us to our conversation this morning. It's quite interesting. We've been talking about this for the last couple of weeks. I wrote an article about it on Tuesday. Mike made some notes and commentary on it this morning in our daily market commentary, which is on the website right now. There's this very bullish underpinning of the market. And look, every day I'm getting tons and tons of emails going, why are you so bullish? I'm not bullish, right? I'm not bearish either. It is what it is. And markets are going up. And as we said yesterday, as soon as you pick a camp, as soon as you pick being bullish or bearish, all your decisions are going to focus on that one camp that you picked. And so it's going to wind up leading you to be mistaken about what's going on in the overall market because you've got a bias. And the one thing we have to fight as investors is our psychological biases, because those get us in trouble all the time. So it's very difficult sometimes if you have a personal bias that's very bearish or very bullish, doesn't matter. You want to try to deny whatever else the other data is. Like, I can't be right.
right? This market can't be bullish because look at all this other stuff over here that's bearish. And this is the challenge of managing money, both short-term and long-term, is, we get wrapped up in these psychological biases. And so the article on Tuesday is talking about this technical bullish formation that we have going on in the markets and these bearish underlying fundamentals. And as Mike and I have talked about numerous times, there's plenty of arguments for the bearish side of the camp. I want to start with Jerome Powell in his speech on Tuesday because, Mike is our resident Fed expert. He's big buddies with Jerome Powell personally. They have lunch and play golf all the time. But there was a couple of interesting comments that I thought Jerome Powell made on Monday that really the market just kind of overlooked. One was in reference to the employment report. We had that 500,000 job employment report last Friday, a real kind of shocker there. He said, look, this underscores the reason why we're hiking rates. I'm paraphrasing. But that was a problem, right? Because strong growth, longer work week, right? People working more hours, not less. That's potential for that wage price spiral that leads to further inflation. The second thing is that he said, look, we're going to keep hiking rates. We're not stopping here because we're not done with our job yet. And the market really seemed to look past both of those and go, they're going to pivot. What are your thoughts on that, Mike?
So what the quote of the week I thought was from Janet Yellen. After the unemployment report, she said that we just had a 53-year low in the unemployment rate. Recession, that ain't going to happen. And, that sounds incredibly logical. Of course it can't happen, right? But if you look at the unemployment rate, you'll notice that it hits its cycle low virtually within 1 to 3 months before each recession.
Yeah.
So the hard part with all this is monetary lags, which, Lance, we talk about all the time. How long it takes from the Fed to tighten rates to fully affect the economy. And I'm concerned that Yellen, not as much Powell, but Yellen doesn't appreciate those lags and that thinks this time is different, that there aren't lags.
Well,
I think
just real quick there, Mike. We have to go back. Yellen's track record is not very good. In 2018, she said, we'll never have another crisis in our lifetime. And we had the 2020 crisis with the pandemic.
Right.
She said and I think it was in 2019, she goes, yeah, there's no recession in sight. And we had a recession like 6 months later. So hers, as well as Ben Bernanke and every other Fed chairman, they're not great with predictions. So
True. And Powell does recognize the lags, and he has been very vocal about it. He's scared of tightening too much, scared of tightening not enough, because he doesn't know what he did a year ago, how that's going to affect things today. And that's the huge problem for Powell and for us.
Well, and I think this is going to be a good pickup point to start our conversation about bullish technicals and bearish fundamentals. The problem is that the Fed is hiking rates, and he is slowing that pace of rate hikes. The market is betting on a reversal of rate hikes as soon as June or July of this year. That seems to be a rather ridiculous bet. But we'll talk about that when we come back from the break. I'm Real Science Roberts with Michael Leibowitz today, talking about bull or bear or both, or what the heck is going on. That's on today's show. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my daughter has friends. Her parents actually raise chickens. And so the family had to go out of town, and they asked my daughter to go over and just watch the house, check the dog, check the chickens. So the first day she goes over there, one of the chickens dies. Chickens die all the time for different reasons, but I didn't tell her that. I'm like, oh my God, you killed one of their chickens? She goes, I don't know what happened. I just walked in to check the chickens and the chicken died. And so she's in a panic for like 3 days while this family's gone. I'm just leaving this thing and run, right? You need to go over there and fess up that you're a chicken murderer.
The Real Investment Show podcast.
She's in tears. She's devastated. She goes over there and she's like, I have to tell you, I killed your chicken. And he goes, honey, they die all the time. It just happens. That's why there's so many of them out there. It's a numbers game.
The Real Investment Show podcast. Same show, your schedule.
She didn't speak to me for 3 weeks.
At realinvestmentadvice.com.
But I had a lot of fun with that one.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Financial infidelity is a relationship buzzkill. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust. Improve your money talk. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So bullish technicals, bearish fundamentals, what do you do with that? It's a very challenging environment that we live in currently. And again, this is, to pick up where we just left off. You know, the Fed is, Jerome Powell's his recent speech talked about the fact they're going to keep hiking rates. They've got to right now. Inflation is still high. It is coming down, but it is still elevated. By the way, we're at 6.4% CPI as of the last report. Now, we've got a new report coming up, I believe, next week, if I'm not mistaken.
Yes.
Mike is nodding yes. But 6.4%, that number will likely come down some more. But the point is that in history, every single time in history, when the inflation rate has been above 5%, the U.S. economy has gone into a recession. We're at 6.4. Yes, it is coming down. But the Fed has been pretty adamant they're going to keep hiking rates until they get inflation on a sustained trajectory back to 2%. And what the market is betting on is that not only is the Fed going to stop hiking rates, they're going to start cutting rates by June or July, which there is no evidence from the Federal Reserve that they're going to do that. And more importantly, what Jerome Powell said, and Mike alluded to this, is that there's a lag effect, and Jerome Powell is very aware of this lag effect of monetary policy. So when they hike rates, it takes 9 months to 12 months for that rate hike to show up in the economy. We've got 450 basis points of rate hikes in the can that have not shown up in the economy yet. So the Fed wants to take their foot off the gas momentarily and say, let those rate hikes catch up to the markets. Let's see what that does to the economy. Does it bring down inflation, et cetera? Or does it break something? And then we'll go from there. Then maybe we'll cut rates if we need to or whatever. But as we've said before on the show, the only reason the Fed is going to cut rates is because you're either in a recession, a bear market, or have a financial crisis, or a combination of the three. That's when the Fed is cutting rates. The Fed will be cutting rates and going back to QE to stop the economy from getting into a deeper recession. They're not going to cut rates if the market's up, the bulls are in control of the market, the economy's doing fine, we're hiring 250,000 people a month. There's no reason to cut rates. That would be nirvana for the Fed. They would sit there and just go, hey, we'll leave rates at 5%, wait for the next recession down the road, and keep reducing our balance sheet. That'd be awesome for the Fed. But the market's not picking that up. Mike, what are your thoughts on this?
The lag effect is huge, and maybe it's worth going through an example of what the lag or examples of what the lag effect is to help people appreciate it. So if we're a company and 5 years ago, we borrowed money at 2% to help run our business. And in a couple months, that 5 years is going to be up. And like most businesses, they don't pay off the debt. They actually roll it over. So they let the debt mature and they issue a new bond. Well, that new bond may be coming in at 5, 6, or 7%. The problem, the reason there's a lag effect is because that may not happen until July of this year. So the economic pain of higher interest rates is not going to affect that company to June or July. So June or July comes, and now all of a sudden their interest expense is going to double or triple. And they're going to have to let go of employees. They're going to have to cut back on production. They're going to have to do something to offset that cost to try to keep earnings where they're at. Interest rate sensitive sectors like home builders, for instance, or even autos to a lesser degree, have the same problem. Mortgage rates change instantly with higher rates, or very, pretty much on the same time frame. But for someone that's just going out to look at houses now, that wasn't looking at houses a year ago, they may just be getting hit with a shock and saying, you know what, I can't afford a new house. I'm just going to stay in my old house. Same with car buyers. And the size of the lag can be months, a month, or it can be well over a year. It just depends when people and companies that are interest sensitive have to borrow money. And that's why, apparently there's a wall of debt, corporate debt, that comes due later this year and next year. And basically, there was not a lot of corporate debt maturing over the last 6 to 9 months. That's going to be changing. And a lot of companies are going to be dealing with interest expenses that are much higher. And they are going to have to take actions, whatever that may be. And so, the hard part for us, this is extremely difficult, is you look at the unemployment numbers and a lot of other economic numbers, and they look fine. But this country is, and by country, I mean government, corporations, and individuals, are so dependent on debt, more so than we ever have been in the history of this country. And that amount of leverage is extremely high. So you have raised rates more than you have in the last 40 years at the quickest pace in the last 40 years. And to not expect that that's going to have a big effect on people's spending habits, on the way corporations run their business, even on the way the government runs. They now have an extra few $100 billion in interest expense. So, as they, especially now with the split Congress, they're going to have trouble with fiscal stimulus if need be, or just regular fiscal spending. They're likely going to have to cut back somewhere, as crazy as that sounds. So this lag effect makes our jobs very difficult. I think Lance and I have this conversation every day. Are we wrong? Are we, maybe this is Goldilocks. Maybe it's just no landing. The economy just kind of muscles right through this. But given the massive tax on the economy and higher interest rates, think about if your mortgage rate were to just increase by $500 next month going forward. That's $500 less you're going to be spending elsewhere. That's a tax. It's essentially a tax. And that tax is slowly just working its way through the economy. And it's not just a small tax. It's going to be a pretty big tax. As people's cars die and they have to buy a new car, they're going to pay that tax. Credit card spending has gone up significantly in the last year. Well, now those people are getting hit with much higher interest rates on those credit cards, and they're going to be working on paying off those credit cards, not taking on more debt. So, that's one side of one side of the way we think about markets is, how's the economy going to handle this? And then the other side is, well, what's the market telling us? What are investors actually doing? And like you said, Lance, there's a big divergence between kind of the logic of the market and the logic of the economy. And that divergence will get filled, and maybe the economy will muscle through this.
Well, that's a very interesting point, because what the Fed and particularly when you talk about consumer credit, that's we've seen a very big increase in the amount of credit cards that people are taking out, and once you adjust that credit card debt for inflation, it's taking a lot more debt to buy a lot less stuff because of the higher prices of food, gas, etc. But when the Fed hikes interest rates, that affects the prime rate, which is directly tied to credit cards. So the biggest increase for consumers is credit card interest payments, which, to your point, are eating up more and more of that discretionary income, which if my credit card bill is getting a lot bigger, that means I have less money to spend elsewhere. So, I mean, when you look at all this fundamental data, whether it's earnings or whether it's the economy, manufacturing data, there's a lot of data that suggests that the economy is already slowing down and slowing down pretty significantly. But then you have this dichotomy of, 500,000 jobs being created, an exceptionally strong job report, as long as you don't look below the surface. And I was talking about in the open, great chart by David Rosenberg out this morning. I put it on Twitter. So if you go to our Twitter page at Lance Roberts, there's a chart of employment. And despite the fact that payrolls have been rising since May of last year, we've created no net new full-time jobs. Full-time employment has been basically flatlined since last May. So everything's being temporary. So even as long as you kind of just look at headline data, there's certainly some fundamental data that supports the economy is doing just fine. Just don't look underneath the hood, because that's where you start finding a lot of issues. But to Mike's point, this is the challenge. So here's the thing so when we come back from the break here in a second, here's the thing that Mike and I want to talk about, which is, what do you do with this, right? And this is why we focus so much on the technical measures of the markets in the short term, because technicals tell us what the market's thinking, right? And it doesn't mean that it's right. Technicals are very short-term in nature, and they can change pretty quickly, when things start going in another direction. Fundamentals tell you what's going to happen longer term. And Mike, I think you'll agree that the fundamentals suggest that returns aren't going to be great. It doesn't necessarily mean, when we talk about not great returns, it doesn't mean we're going to be in a bear market for the next 10 years. But based on valuation, based on the fact you don't have stimulus payments in the system, all that stimulus has now left the system, you've got excess debt now. There's a lot of things suggesting that growth in the economy and growth ultimately in the markets will be a lot less in the future than it has been over the last decade. But the technicals in the short term suggest opportunities that may create some money in the short term. So when we come back from the break, this will be the point that we want to get to, is what do you do with this information that we have now, right? The technicals versus the fundamentals. How do you blend that into a portfolio, and where should you be looking for opportunities? And I think the one thing, Mike, that we need to touch on more importantly is in a slower economic environment, where do you want to be looking to invest? And this is going to be kind of the issue. So real quick housekeeping, just to make sure, don't forget to go by the website, realinvestmentadvice.com. Our 3 minutes on markets and money that we used to do now has its own channel. It's called Before the Bell. So go over there and subscribe to that, and that way, just click the little bell icon, subscribe to that channel. That way, when we post a new Before the Bell post each morning, you'll get a notification of that on YouTube. Real Investment Show, make sure and click the little bell icon while you're sitting right here watching the show. We appreciate your subscription. Also, get our website, subscribe to our daily market commentary, our weekly newsletter. There's so much stuff there. It's all free to help you navigate markets better and make money for yourself. That's the whole point of all of this. realinvestmentadvice.com. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So here's the problem for investors, and this is the big challenge that we have, is navigating all of this bearish fundamental data, right? I mean, and look, there's plenty of it out there, and this is the whole issue, right? I mean, I talked earlier this week about the Jim Rickards video that has been circulating the rounds, suggesting the world's going to all end, and that's, you know, the worst possible outcomes never occur. Can you have bad outcomes? Yes, but generally the worst possible outcomes of the next Great Depression don't occur. And again, we have a lot of differences today than we had back in the Depression. Everybody wants to refer back to the 1930s, and we're going back to that. No, we're not. There's a lot of differences. We've got FDIC insurance. We didn't have, bailout programs in place. We didn't have the Federal Reserve acting the way they act now versus the way they were doing back then. So there's a lot of different supports for markets and environments that will keep us out of a depression. So, betting on that outcome is likely not going to be a good bet. Now, can we have a bad outcome? Absolutely. And there's certainly a lot of economic data that points to that. Here's the problem, though. The technicals right now in the markets are very bullish. We've talked about numerous times on the show. Inverse head and shoulders, which is a historically good kind of bottoming process for a market, suggests that a market bottom has been put in. Hard to believe given the economic data, but that's what the data says. We've broken the downtrend line from January of 2022. So that bearish trend has now turned into a more positive trend, at least for now. Technical indicators, the 50-day crossing above the 200-day moving average, that's the golden cross. Historically, not always. There are times that the golden cross has not produced positive returns, but the majority of the time, if you're a betting man and you're going to Vegas and you're betting the odds, you would bet on the golden cross leading to higher prices. One thing it does provide is support. So that golden cross now, the 50-day crossing above the 200-day, is now a good level of support for a market on a pullback. So what do you do with this data? And how do you invest with that? And where do you invest? That's the bigger question, right? Where in this economy are you going to invest in an environment? Well, two things to take away from this. And then I'm going to turn this over to Mike and let him run with it. The first thing is that technicals are very short-term in nature. They're a month to 3 months to maybe 4 months in nature. So when you get technical signals, they're good for short-term. They tell you that the market psychology is bullish and that things are rising. We need to pay attention to that
add exposure, do those type of things. When those technicals change, that is when the market fundamentals are beginning to catch up with the market. So that's why Mike and I pay so much attention to the technicals, is because it gives you the opportunity and gives you warning about changes to the market environment. So Mike, having said all that, technicals bullish right now, economy, weakening, if not going into a recession at some point. So, in that environment of a weakening, slower growth environment, where do I want to be investing, and where should I maybe not want to be investing or be invested, particularly considering, the sectors and markets that did so well last year? What should I be thinking about going forward this year? And he's talking, but I hear nothing. So
sorry.
There he is. Try it again.
So much. That was my fault. So much of this is valuation and time frame. So if you're asking a question, where should I be investing for the next 2 weeks? If you look at what the market's been doing, if you look at where the momentum in the market is, it's clearly towards the beaten up stocks from last year, this tech sector, the conservative sectors that did really well last year, like healthcare, utilities, staples, are not doing nearly as well this year as some of the other sectors. So if you're looking at the next 2 weeks, 4 weeks, think about some of those sectors and the companies within those sectors. But as you start thinking about, okay, well, I have a poor outlook for the next year, and I'm just going to invest for the next year, and I don't care about the ups and downs. What should I invest in? And the first thing is just your asset allocation. How much cash are you sitting in? How many bonds are you sitting in? So the first thing is just think about maybe just reducing exposure to equities and either increasing in bonds or cash, depending on how you think about bonds. But it's also valuations. So, just because a company's a conservative company, a staple type company, a utility, doesn't mean it's cheap. We've talked about Clorox, about Procter & Gamble, which we do own. They're expensive companies. They're more expensive than the S&P 500. On the other hand, there are companies that are much cheaper. But the problem is, and what makes this really hard is, if the market's going to sell off and if money's going to flock to the conservative sectors, will it flock to the big companies that everyone knows, Clorox, Procter & Gamble, for example, Coca-Cola, McDonald's, or will it flock to those lesser known companies that are truly cheap and most likely have less downside? So that's another thing we have to keep an eye on, and that's basically what we call passive flows versus active flows. So, Lance, we started this year with the word audible. Mm-hmm. And to me, audible is the key word. And it's not just, are you going to audible in and out of stocks or in and out of bonds, but which sectors are you going to audible into and out of? Which stocks are you going to audible into and out of? And that's where it gets difficult. It's easy to go back to last year and say, okay, the market's going to go down. I'm just going to play the same playbook I played last year. And that may very well work, that those very conservative, high dividend companies are the best performers. That's what typically works during a recession. But also, and I'm going to make a case for high growth companies right now. Mm-hmm. In a recession, interest rates are going to plummet. And right now, interest rates are extremely high. If we go into a recession, there's a good chance interest rates go down sharply. So companies that have good earnings, that are somewhat recession proof, that are growing, but are considered high growth, some tech names, maybe not the top tech names, maybe not the Apples, Microsofts of the world, but go down 1 or 2 levels from there, and you got companies that are growing at fast rates that have beaten down valuations. We talked about Meta not that long ago. Right. That when interest rates come down, the mathematics behind valuing companies really helps companies that have growth in the future. So, it could be a weird year where we're buying conservative companies and higher growth companies and kind of straddling the line. But again, we're going to be audibling. We're going to be seeing how the economy does. Right now, the economy is fine. We're not in a recession. We're not really close to recession. Now, that can change in 2 months pretty quickly. But right now, everything seems fine. Yeah. So it's just thinking about all your options and what does the future hold? And then, again, back to technicals, Lance, that should also help drive your decisions.
Yeah, and I think and too, I just wanted to point out that every Friday on SimpleVisor at simplevisor.com, which is our subscription service, you post and you've been doing a whole series lately on you and Nick Lane, our analyst, have been doing a whole series of 5 companies. We have what's called 5 for Friday. It's a report that goes out and goes through 5 companies that we screen, looking for different opportunities. And lately, you've been touching a lot on value and value dividend growth, those type of things. And it's been, it's interesting to see some of those names that are coming up that, may provide some decent opportunity in the next downturn of the markets. So if you want to check that out, by the way, we always post one of the companies in our weekly newsletter. So if you go to our weekly newsletter, go to realinvestmentadvice.com, you can see one of the companies in our newsletter each week. Subscribe to the newsletter. We'll email that to you at the weekend. But you can also try out simplevisor.com for 30 days free, and that's our complete kind of research portal that we post all of our research to. So if you want to check that out, that's there for you. But I think one of the kind of the interesting aspects, and again, the one thing we have to consider is, and I completely agree with you about, growth potentially picking up in a slower economic growth environment, companies that can actually grow earnings in a weaker environment. But we also have to consider, and this is some of the reasons why we own companies like Microsoft, we own Procter & Gamble. Yes, we know that they're expensive, right? But there's also this passive indexing effect that we've talked about before, that if people began to start chasing tech stocks, as an example, they're going to be buying the XLK ETF, which is going to funnel money into those top 10 stocks. Same thing with if they're all buying value, they're going to buy a value ETF that's going to funnel money into companies like Procter & Gamble, which are in those top 10. So part of the thing that's been becoming more difficult over the last decade with the rise of ETFs is that you also have, this is a new factor that we have to factor into our analysis of what companies to buy is, okay, this is a good value company, but this company's not necessarily a value, but it has a big passive indexing effect. So you've got to almost hold both of them, right?
Right. Here's the conversation that's going to happen. Someone's going to call their broker, hey, I was down 20% last year. The market's starting to head lower. I can't lose more money in my IRA. The broker's going to say, well, you have to stay in stocks. That works for the long haul. And then the broker's going to say, but here's what I'm going to do. I'm going to move you from the growth fund, from the S&P fund to the value fund. It's more conservative. It won't go down nearly as much if the market goes down. So they're going to be selling growth names, tech names, and they're going to be buying the Procter & Gambles and the Cloroxes, no matter how expensive they are, because that's what leads the value indices.
Yeah, that's absolutely right. Like I said, if you want to get access to our research platform, it's called simplevisor.com. You go try it out for 30 days for free. Has all of our research on it. We post weekly 5 for Fridays, get access to our newsletter, more. It's all there at simplevisor.com. Of course, make sure you go by realinvestmentadvice.com. As I said earlier, our newsletter, subscribe to that. It's our weekly subscription, goes out. You also get our Technical Tuesday Take as well. Separate email list if you want the daily market commentary. Subscribe to our Before the Bell channel. That's our new channel. That is our 3 minutes on markets and money before the bell every morning. And then, of course, this channel. Make sure and subscribe here at The Real Investment Show. Lots of stuff for you, always free at the website. And if you're there and need to ask a question, feel free to click on the Ask a Question button. I answer every email every single day, so don't hesitate to ask a question. realinvestmentadvice.com. We'll see you back here tomorrow for Financial Fitness Friday. Have a great day.